The Banking Paradox, Jefferson's Warning and the Rise of Monetary Tyranny. 1. The First Warning. In 1791, while most of the young republic was still trying to figure out how to pay for the revolution, Thomas Jefferson saw a new danger on the horizon, one wrapped not in redcoats, but in ledgers and contracts. He called it the central bank. Alexander Hamilton wanted it. George Washington signed it. Jefferson, however, wasn't fooled by the polite language of stability and credit expansion. He saw what it really meant: control over money equals control over people. Or as he put it, banks are more dangerous to our liberties than standing armies. So what does that actually mean? It means you can defend against an invading army. You can't defend against debt that never stops compounding. Jefferson knew this, and he knew the pattern: whoever controls the money supply eventually controls the nation. Footnote: Jefferson warned that central banking would turn economic dependence into political slavery. 2. The Empire of Credit. When the first Bank of the United States opened, it looked harmless, patriotic even. But beneath the marble columns and quill pens sat a machine that could issue currency from thin air and lend it at interest. 80% of it was privately owned. The government held its deposits there, and the new money it issued was backed by the same private interests that profited from lending it. Jefferson's nightmare had officially begun. He called it financial tyranny disguised as progress. And when the bank's 20-year charter expired, it was replaced with a new one, bigger, richer, and even more unaccountable. So what does that actually mean? Each new crisis brought more control, more concentration, more dependence on the same people who caused it. Sound familiar? Footnote: private ownership of public credit became the core engine of American finance, not an accident of history. 3. The Jackson Rebellion. Andrew Jackson, no fan of subtlety, called the second bank a hydra of corruption. When its president, Nicholas Biddle, tried to crush Jackson by crashing the economy, the old general famously barked, "The bank is trying to kill me, but I will kill it." And he did. The charter expired in 1836. America went bank-free for nearly 80 years, and thrived. Expansion, innovation, and the industrial boom followed. No central bank. No monetary guardians. Just competition, chaos, and an economy that somehow worked. Then came the panic of 1907. The bankers cried crisis and summoned a meeting at Jekyll Island. The result? A plan so clever it could pass as reform while cementing private power forever. Footnote: Jackson's destruction of the second bank temporarily restored monetary independence, until private finance rewrote the rules again. 4. The Federal Reserve Masquerade. Christmas Eve. Congress was half empty. The Federal Reserve Act slipped through like a thief in the night. And just like that, Jefferson's ghost was back, only now with better branding. They called it federal. It wasn't. They called it reserve. It didn't. They called it a system. It was a cartel. So what does that actually mean? It means private banks designed a public institution to serve themselves, and they made sure this one had no expiration date. The first two central banks had 20-year limits. The Fed? Permanent. Footnote: the Federal Reserve achieved through marketing what earlier bankers failed to achieve through politics: indefinite control of U.S. money. 5. The Modern Consequence. Fast forward a century. The dollar has lost 97% of its purchasing power. The national debt has ballooned past $36 trillion. The same private interests Jefferson warned about now create trillions out of nothing, and lend it back to the government, with interest. In 2008, the Fed bailed out the banks with $7.7 trillion. Ordinary Americans lost their homes. The message? Profit is private, loss is public. Jefferson saw it coming. He said once banks control currency, the people will wake up homeless on the continent their fathers conquered. So what does that actually mean? Every financial emergency expands the Fed's reach. Every crisis makes us more dependent on the very system that caused it. Footnote: The 2008 and 2020 bailouts demonstrated Jefferson's prophecy in real time: central banking as permanent wealth transfer. 6. The pattern that never dies. Crisis. Expansion. Dependence. Repeat. From 1791 to today, every economic disaster has led to more centralized power, not less. Jefferson called it a quiet revolution against liberty. The Federal Reserve now sets interest rates, manipulates credit, and monetizes government debt, all without a single Democratic vote. So what does that actually mean? It means 7 unelected people now have more power over your wallet than Congress, the courts, and the president combined. Footnote. The Federal Reserve's independence is its greatest political armor, and Jefferson's worst nightmare fulfilled. 7. The joke that isn't funny. Here's the punchline Jefferson didn't live to hear. We still call it our money. In truth, it's rented, at interest, from a private system that manufactures dollars out of thin air. And if that doesn't sound like a national prank, nothing does. So what's the solution? Jefferson already gave it: return the issuing power of currency to the people. Simple. Uncomfortable. Revolutionary. And maybe that's the real lesson: liberty isn't lost in a day. It's traded, one loan at a time. Footnote. The ultimate remedy is decentralization, restoring money creation to public accountability rather than private profit.